Thank you. I hope everyone can hear me okay. And good morning, everyone. Thank you for joining us today on day 2 of the conclave. As we've already been told, we have a fabulous panel of speakers today to discuss secondaries in India and how it fits into the liquidity jigsaw in the Indian market. So today, hopefully, we'll be covering a few of the key themes, a state of play of the Indian market, how we've got to where we are, and what the sort of pipeline looks like. And hopefully a bit of a lively LP-GP debate as well around what the typical investor concerns are with this market and how GPs can try and can address those. So starting off with some quick introductions maybe. So I'm Shantanu Naravne, a partner in the funds team at HSF Kramer. We're a global law firm with around 26 offices and 3,000 lawyers globally, but particularly active in the funds practice within the secondary space across your LP-led transactions, GP-leds, continuation vehicles, and also direct secondaries as well. And in the Indian markets in the last couple of years, we've been quite active in the private equity and real estate space in particular. Going down the panel, starting with you, Ankita.
Sure, thanks. Thanks, Shantanu. Good morning, everyone. My name is Ankita Baheti. I'm an investment director at Schroders Capital. Just as a little bit of a background, Schroders is a global asset manager with presence across public as well as private assets. Schroders Capital, it's this $100 billion private assets arm. We've been present in India for the past 15 years with investments across fund of funds, secondaries, as well as co-investments.
Hers is working. Kevin Edwards, Carnegie Mellon University. We're a $4.5 billion endowment in Pittsburgh, Pennsylvania, in the US. We are very much believers in private markets. Roughly half of our portfolio is invested in private markets with highest weighting in venture capital, where we focus on early stage, followed by buyout, which is a lower mid-market focus. We're global in our approach. We've been investing in India for a bit over a decade, and I'd say taking a much more concentrated look at the markets over the last several years.
Good morning, everyone. I'm Rohan Ghosh. I'm the director at Blue Earth Capital. I lead our Asia business. Blue Earth Capital is a multi-asset class, multi-geography private assets manager focused solely on impact investing. We've been around for about 12 years, and since our inception, we've been investing in India. We invest across asset classes, but for the last 6 or 7 years, we've been doing a fair bit within secondaries of different stripes, LP-led secondaries, GP-led secondaries, and direct secondaries, and been investing in India in secondaries for that period of time as well. Good to meet you all.
Hi, I'm Jason Sambanyu. I'm the founder and CEO of Foundation Private Equity. We are a secondaries-focused fund manager investing across Asia. We focus on GP-led secondaries as well as secondary direct secondaries, or whatever you might want to call them. And we are actually in the process right now of creating a more permanent presence. In India. We're in the process right now of setting up our own Category 2 AIF, which will focus on secondary transactions in India, mainly focus on GP-leds, but also with some secondary directs as well.
Oh. Right, okay. Okay. Technology challenged. Good morning, I'm Erwin Rooks. I'm a partner at Bex Capital. We are a specialist secondaries firm in that we only buy positions in fund of funds, secondary funds, and co-investment funds. We run in excess of $2 billion out of offices in Nice in France, which is where our main office is, and our office in New York. I myself have been in secondaries since the early 2000s when I started the secondary business at AlpInvest, which was then, I suppose, the largest private equity investor in the world, now part of Carlyle.
Thank you, everyone. So I suppose starting off with a bit of scene setting for those in the room relatively new to this space. So globally, secondaries have been around for a very long time. And in the last couple of years, there's been an increased amount of activity in this space because of things like the lack of capital markets or your conventional PE exits as an exit option for GPs. And globally, what we have seen is a bit of an evolution from your classic LP-led transactions, which is essentially investors in PE funds transferring their interests to others, to GP-led transactions, where it would be the GP setting up a new structure and transferring assets across with some new investors and some existing investors rolling over, to what Jason mentioned, a sort of direct secondary transaction where you have people buying off specific assets or portfolio of assets from existing funds. But Jason, based on the conversations we've had before, the direction of travel or the evolution in India seems to have been almost the reverse, where direct secondaries was how the market has started off, and now we're seeing a move into GP-leds and continuation vehicles. So maybe if you could start us off on the state of play as you see it in the Indian market and how we've got to where we are.
Yeah, so I've been investing in Indian secondaries for 19 years now, and I think it's safe to say that we're now entering into a new phase of the development of the industry, whereas until about 3 years ago, the vast majority of capital that was investing in Indian secondary transactions was coming from overseas, whether that's a big global player like Schroders or Collar or Lexington. They would come in from overseas and back transactions in India, mainly GP-led transactions, mainly in funds that had been raised overseas, so US dollar funds, whether Mauritius vehicles or Cayman vehicles. That was, the India secondaries landscape until about 3 years ago. But it was about 3 years ago that we noticed that increasingly there were a number of transactions happening kind of GP to GP. So kind of some degree of what we would call kind of sponsor to sponsor transactions. But with that also an increasing number of secondary direct transactions. In other words, specialist buyers of direct interests in deals that had previously been invested by other GPs, right? And there are a few firms that have been here, a couple of firms that have been here in India for a while doing that. Madison India as being a notable one of them. And of course you have some of the overseas investors like NewQuest and TR Capital. But increasingly we were starting to see more local players kind of emerging and doing secondary directs, and I think that was very interesting because together with that has been the emergence of a completely new kind of subclass of a subset of the Indian secondaries market, which is secondaries taking place around domestic vehicles, typically close-ended Category 2 AIFs. And that activity, I think, is just, is emerging. We think it's very exciting because that tells you that the Indian private equity market as a whole is now maturing to the point that you have domestic players forming capital and going out there and looking for deals. Interestingly, and we can talk about this maybe a little later, as with Asia 19 years ago when I got into this industry, the emergence of the Indian secondaries industry has mainly been through direct secondaries, i.e. these specialist buyers of direct positions from other GPs, and not so many LP secondary type of players, and indeed relatively few, if any, focus on the GP-led market, right? So what I would say is that the Indian secondaries market as a whole on the US dollar side has, I think, reached, it's in the what I would say maturing phase. And then you have this emerging phase of domestic AIF secondaries. So very exciting times because you have these two engines, right, of the Indian secondaries market, particularly because, and I think the McKinsey report that was shared on some tables shows that an increasing number of LPs, and maybe my colleague from Carnegie Mellon can speak to this more, true LPs, what I would call true LPs, are increasingly looking to allocate to India. And it just means that as more allocations happen, both at the downstream secondary piece as well as the upstream kind of fresh capital, to capital coming in, I think you're in for very exciting times in the secondary market here in India.
Thank you. That's very interesting. And Ankita, just picking up on that, as in obviously Schroders is a global platform, and within that you focus on the Indian market. Sort of what similarities and differences do you observe between the Indian ecosystem as compared to what you see elsewhere?
No, I think we spoke just about a little bit more on the, I think, demand side of things in terms of secondary investors. I think the difference that we see a lot more, at least when I kind of compare internally, the market that we see on the secondary side in US, Europe, and Asia overall, I think I would say that on the supply side of things, in terms of secondary opportunities, we're still in the early stages yet. And let me kind of throw in a couple of metrics over there. If you kind of look at overall AUM, right, like private equity AUM, Asia used to have up to 20% kind of allocation. It's kind of dropped now to between 10 to 15% allocation. But I was reading this report very recently which said that in terms of secondary deal volumes, Asia is currently contributing to less than 5%. So secondary market essentially kind of comes about as a consequence of driving liquidity from existing investments. Now there are different ways to kind of achieve that, where you kind of hand it over to the next investor. You kind of continue it, holding on to it in a continuation vehicle or GP-led, which kind of focuses on star assets. But disciplined kind of DPI management is always going to drive that secondaries kind of opportunity. And I think that is something that we're starting to see a lot more acceptance, adoption. People are starting to think about it very, very actively in terms of coming up with interesting structures. And I think that eventually kind of drives people to also believe that the latent market exists, because a lot of these assets will kind of come to market. I do want to call out the fact that specifically with India, given the way the IPO markets have really been on a good run over the last couple of years, have helped a lot of private equity investors kind of being able to drive distributions in DPI from IPO markets. But I think GP-leds and direct secondaries are going to be around in the long term as well, because they kind of serve a very specific kind of need. And I think just in terms of kind of driving balance, that's what would be good to see over the next couple of years. I think the other difference that I would generally kind of point out would be the level of adoption that we're starting to see for GP-leds. I think the last couple of years have been very interesting with all of the major Indian GPs kind of starting to think about GP-led opportunities, and have successfully completed 3 continuation vehicles between the 3 of them. Has been interesting, and I think we're starting to see a lot of GPs in the mid-cap stages as well, also starting to think about this technology, just because it's been now demonstrated to have been achieved kind of successfully. What we haven't seen is some of the global GPs also starting to think about India-specific continuation vehicles, which is something that been invested in India for quite some time. It would be interesting to see how that kind of evolves over the next couple of years. Should present a good opportunity. And I think just one additional aspect, I think more from a structure perspective, is to have a single asset vehicle is something that is now starting to gain, I understand, some amount of regulatory support as well, which was not possible previously, but now is possible in certain exceptional cases. I think that kind of administrative support is also going to be pretty helpful, which doesn't exist at the moment, but I think we're heading in that direction.
Yeah, no, thank you. I think the NSE single asset vehicle gathered quite a few headlines, and yeah, it'll be interesting to monitor that development. So then I suppose turning to you, Kevin, as an investor in the space, because we talk about secondaries delivering liquidity, delivering DPI, etc. So does this surge of secondaries, is it exciting for an investor? Does it give rise to some concerns? And then what's your perspective on it?
Well, exciting in that at some point we have to get paid. Otherwise, why are we doing this? So there is a liquidity issue, and historically that was the rap on India, was that you put money in and you never saw DPI. You might have good marks, but you never got money out. And to make that case in point, we have some older funds, 10 years plus. One of those 8 funds that are older has a DPI of 1 or better. 1. So think about that. However, flip side, how things have changed, is when I started first coming here 3 years ago, I didn't even have to mention DPI. It was the GPs who were bringing it up in my meetings. So they got the message. And so hopefully that will translate to actual liquidity management, of which secondaries certainly are going to be a key part of that. And I think especially sponsor to sponsor, as I mentioned, in the venture side, we tend to go earlier stage. And so the hope would be that as funds, as companies develop, as funds get longer in life, that they're looking for an exit ramp that really crystallizes the return and the valuations that they've put in place. One thing we see in the U.S., and we have not come across secondaries in India yet, but we see it all the time in the United States and Europe. And our biggest issue as an LP is alignment with GP leads. So we're sitting back, we think we've been a good partner, we think we've developed this great relationship. All of a sudden we get this notification, hey, we're doing this continuation vehicle, and lucky you get to sell your interest at 70 to 80 cents on the dollar. You can imagine how that goes over. Not very well. And on top of that, the GP gets to crystallize their carry. So again, you've just got really bad alignment. So I would hope as the GP-led transactions start to take off in India, that some of those lessons can be learned, and perhaps those conversations start with the partners. That the GPs approach their LPs, say, hey, we're coming down to fund life. SEBI is much more active. In the US, it's like you just keep extending. But SEBI has become much more active in making sure that, no, there's a fund term. So that, which I think is great. But GPs go to your LPs and say, hey, this is the situation. We think a continuation vehicle makes sense. Let's talk this out. Let's figure out what will work for everyone. Because otherwise, as an LP, I kind of have a gun to my head. I either take a 20, 30% hit, or I roll and extend that, what I thought was going to be, maybe a 10 to 15 year time frame of investment, and now it's 20 plus. So again, it's really an alignment issue, but that's hopefully that paints the picture.
I think it's, I want to pick up on something you said, Kevin, because alignment clearly is the crux of it all, but it's also about communication, right, and transparency. Because, and this is what, whenever we encounter GPs that are contemplating a continuation vehicle, one of our first questions is, have you had a conversation with your LPs, right? Because every discussion around a secondary transaction that's being led by a GP, the GP should have the first conversation with his or her LPs, right? Before talking to someone like us, before speaking to a secondary direct player, because it's so vitally important, to Kevin's point, that you do right by the partners who've been there for you from the beginning of that fund, paying the management fees, going through the J curve with you, and at the point where the fund is starting to generate liquidity, that's the point at which you need to really start communicating very heavily with your LPs about what is the right liquidity plan for this portfolio within the next few years. And as you look at that plan, does a continuation vehicle become part of that plan, or could it become part of that plan by virtue of necessity? Because I think, again, I don't want to speak on anyone's behalf, but I think most LPs are pretty open-minded when they hear that certain things happen around a portfolio that may require an extension past a certain point, right? And so this is such an important part of the nature of the secondary deal, especially for GP-leds, which is you got to have really good communication with your LPs before you contemplate a transaction, during the transaction, and even to some extent after the transaction, right? Because these are the long-term relationships that you had invested in to build that fund, and you want to make sure that after a GP-led deal, everyone feels good about it, right? And that is the ideal situation. Everybody gets something out of the transaction, because whenever you have LPs who are on the other side of, on quote unquote, the wrong end of a GP-led deal or a continuation fund deal, that could really undermine your franchise over the long term, and that's not what you want to do.
Agreed. And I suppose we have been having a lot of these conversations in the sort of globally for a longer period of time than we have in India. And so I suppose, Owen, turning to you, picking up on some of those points, how have you, there's the point around communication, which Jason mentioned. Are there any other examples of what's worked well in your experience when you've been in your years operating in the space globally?
Yeah, so different from most other panel members, what we do at BEX is very much LP-led. So what we do is more a function of mature private equity markets where large institutional investors, for whatever reason, it may be strategic, it may be change of a CIO or regulatory, have to restructure their PE portfolios. So when we buy into our deals, we typically buy into highly diversified risk, which is actually the premise on which we started BEX about 10 years ago, when we said what we want to do is want to go back to the origins of private equity secondaries, where you buy highly diversified risk at a discount. So basically, in what we do is we buy cash flows. We don't buy companies. When I do a deal, I typically buy into hundreds of funds in one go. I buy into thousands of companies in one go. So we buy highly, highly diversified risk. And therefore, as I said, it's more a function of really mature private equity markets. Now, with regard to the GP-led side of the market, which is more relevant, I think, to the Indian market, I have to agree with Kevin that not all LPs are particularly positive about that development, as they are often forced to make a decision they, at the outset when they decided to invest in a fund, weren't called upon to make. So they find themselves in a position where, and often, don't forget, I mean, there are some really huge institutional investors that have very, very small teams in private equity. So these small teams, when they get faced with a GP-led and have to make a decision, they're ill-equipped to actually dedicate the time to come to a considered decision on these. So it does create issues for the LPs. It does also create issues for us, because in the past, when we bought positions in secondary funds, we knew that we were buying diversified risk. Now, with all the GP-leds happening, all of a sudden, there's a lot more concentrated risk in the secondary funds we buy into, which presents an issue for us as well. Because now, instead of doing top-down, looking at huge portfolios, which is a data exercise rather than a company exercise, we all of a sudden have to look at companies again, which is something we thought we had gotten rid of. So it also then puts a lot more time constraints on us, because we are now all of a sudden going to have to analyze companies, which is not something we thought we would have to do going forward. So that in a nutshell is basically, I suppose, the future for India. Once your markets have developed and you have large institutional investors, pension funds, which are going to restructure at some point in time their portfolios, we'll be happy to be part of that new landscape.
Thank you, Owen. I think that perspective on LP-leds is really interesting, because there are a couple of, I suppose, structural reasons why LP-leds in India haven't taken off, as in there are obviously some tax considerations with potential double layers of taxation. But Rohan, based on the conversations we had, there's also a point there around what the existing LP base in India looks like and how keen they are or are not to participate on the secondary side of things. So given your experience in this space, particularly in the sort of, a lot of your investments have an impact lens to them, how do you see that dynamic playing across when you're having those conversations with sellers into the secondary market?
Sure, I think that's a fair point. So we have a unique position where we do both LP-leds and GP-leds. and the market in India for both is relatively nascent compared to developed markets, which is potentially a good thing in a way where we can learn from what's worked well in US and Europe for both of those two sub-asset classes. So maybe just taking LP-leds and starting with that. What we have seen, and we've done a few of LP-led transactions in India, what we've seen is that the seller profile for LP-led transactions reflects the current LP base, as you would expect for funds in India. If I look back at the vintage of the funds that we would potentially transact on within any LP-led transaction, we're typically looking at funds that are of, let's say, late 2010 vintage, so let's say 2018, 2019. And in those cohort of funds, the LPs are largely concentrated, at least for the opportunities we've seen, around DFIs who have structurally a mandate to support early fund managers and take on blind pool risk effectively for those funds, which is great from an impact generation perspective. But the way we look at it as a buyer of those positions is that we would want to have a greater diversity of LPs who are selling their positions in those LP-led situations. When we do have these conversations with multiple DFIs, there's a spectrum of receptivity towards such a transaction. There are many DFIs who are aware and would like to work with us to create liquidity and show proof of concept for generating LP-led liquidity in markets such as India. And we've seen and worked with at least 2 or 3 DFIs in India already on that. However, the broader pool of other investors, there's still a bit of a reluctance to look at LP-led transactions, given a relatively broad bid-ask spread that we've seen based on current valuations that those funds would carry assets at. We've also worked through it with many sellers in coming up with innovative structural solutions to mitigate that risk, whether it's around deferred payments, whether it's around preferred equity, whether it's around earnouts. And so there are mechanisms that we've used to bridge that gap. But I would say that that's learned from multiple LP-led transactions which have happened in developed markets successfully using these tools. And hopefully we can increase the volume in LP-leds as the industry in India matures anyway. On GP-leds, I completely agree. There is clearly an alignment challenge that we've seen in the transactions we've done. It's a reflection of the fact that in developed markets as well, that challenge does exist, but the secondaries market is a bit more mature, and therefore GPs oftentimes know when to have that conversation with LPs in advance with a narrative which oftentimes is received quite well. Whereas given this sub-asset class around GP-leds is relatively new to India, what we have seen is that in many situations, those conversations happen quite late in the day and not with necessarily the right narrative. Even as a seller, even as a buyer in GP-leds, the narrative that we often would like to hear and would like to sort of gain conviction on is not that we can't find an exit for this asset. It should rather be we as a GP would like to support the further stage of growth in this business, although there are other liquidity options available right now for those assets. So I think from our perspective, the narrative is incredibly important as we seek to build alignment with LPs in the fund, with the GP in the fund, and also as secondary investors in any CV.
Thank you, Rohan. And I see the SEBI chairman has just arrived as well. So I think in the couple of minutes that we have left, we've talked a lot about the commercial drivers in the Indian market, which is leading to the surge of secondaries. Are there things about the nature of the funds that have been set up historically, or the regulatory environment, Jason, which is another thing that was mentioned, which has sort of driven it as well?
Yeah. No, and we were having a chat about this amongst the panelists when we had our pre-panel call. I think, truly remarkable, I think, in the context of global financial markets. I'm not just talking about in the region or anything. What's truly remarkable about the Indian domestic AIF industry is the fact that SEBI has laid down a very clear process of what happens at the end of an AIF's life, right? A category 2, assuming it has an expiry. The dissolution scheme that the SEBI has put into place is very progressive because it really kind of pushes GPs to have an open and honest discussion about what's going on with the portfolio at the end of its life, right? And what are the options going forward as the investors of a fund consider an extension, if that's still even possible, because SEBI has also made clear that an extension of an AIF's life beyond what's been written in the PPM requires a specific type of process to take place, which, by the way, remarkably looks like a secondary transaction. But even before then, I think what the consequence of that is that, apart from, I think, generating, interesting deal flow for investors such as us who are looking at, kind of the AIF market, and we're setting up a dedicated fund for it, is the fact that the knock-on effect is that it will compel GPs to have these conversations with their LPs sooner rather than later about what is the true value of the portfolio and how we're going to get exits from this portfolio, right? And I think that will enforce a certain level of discipline in the industry as a whole. And it's something that, frankly, I think is, and Kevin can probably talk about this, is sorely needed in even the US in the US private equity market, where today I think it's generally agreed amongst LPs that the entire industry is inflated in terms of its value, and it's in desperate need of a markdown. So and of course, and frankly, some people say, why do you care as a secondary investor if the portfolios are marked up? You just put more of a discount. The reality is, a highly discounted deal is a lot more difficult to pull off than one that, anything which is like 40–50% discount is a lot more difficult to pull off than something in the 10 to 20% discount range, right? Because nobody wants to feel like they've got the wool pulled over their eyes. And especially if it's the people who've been investing with you for 8–10 years. So the sooner you as a GP can mark your portfolios at a more reasonable valuation, that should enable a more fair and open discussion about what the value of the portfolio is, and is there a place for a secondary transaction in all of that. I think the better off we all are as an industry, frankly.
Thank you. I'm afraid that's all we have time for today, but this is a topic we can go on having discussions about, which we can do over the course of today. So thank you once again to all the panelists and to all of you for joining us today. Thank you very much.